Having seen market cycles over 30 years, boom, bust, and all of it, what is that one core principle that has stood the test of time for you?
It is the principle of not being bothered too much about how much money somebody else has made.
How do you find ideas in today's time in terms of price discovery and finding the right opportunities?
There is no fixed rule here. Ideas can come from anywhere. It can come from a casual conversation. It can come from a shopping experience. It can come from one of our brokers who are on our panel. It can come from one of our own people, analysts. So it can come from anywhere. But the important thing is that we weigh it against the mandate of the product. That is very important because
everywhere there's news about, okay, you should buy this, and defense is rallying or different sectors are rallying, and everyone's trying to time the market. But what you're saying is very contrarian. So I want people to understand this deeply.
I would classify investment styles into two broad categories. One is trying to achieve investment success by doing the right things. The other method is trying to achieve investment success by avoiding the wrong things. Yes, it does sound very simple, but I assure you it is not easy. The four factors are these. Don't buy measurably weak or deteriorating businesses. It is easy to identify them. Don't buy any company where the management of the company has shown a tendency to go against the interest of minority shareholders. Don't buy at exorbitant valuations. In other words, don't fall for hype. And fourth is what we earlier discussed. Don't be bothered too much about how much money somebody else has made. In my opinion, this is the root cause of all problems.
So when do you decide when to sell? Hello and welcome everyone to the India Opportunity Show. I'm your host Shrishti, and today I'm thrilled to welcome one of India's most respected investors, Mr. E.A. Sundaram. He has spent over 3 decades in the public markets across institutions, mutual funds and family offices, and currently serves as the CIO of Bugle Rock. He's built his reputation by following a simple strategy which he calls common sense investing, focusing on governance, avoiding mistakes, and letting compounding do its magic. What I admire about him is not just his track record, like he avoided the IT boom in 1999, infra in 2007, mid-caps in 2017, and NBFCs in 2018, but also his philosophy and contrarian thinking. EA brings a rare ability to connect temperament, discipline, and spirituality to the craft of investing. This conversation isn't about chasing the next hot stock. It's about frameworks and timeless principles that will stay with you for decades. Hope you enjoy watching this fantastic conversation with a market veteran and stalwart investor. Thank you for tuning in today. Good afternoon, EA. Welcome to the India Opportunity Show. Thank you for joining me here today.
Thanks for inviting me.
You know, your journey has been truly legendary in the stock markets. A lot of people have so much respect for you in terms of your approach to investing. Because you've truly focused on first principles thinking and your approach, as you call it, common sense investing in a big way. And I really wanted to get your insights out to our audience today, because I think this level of insight and in-depth thinking is lacking from the audience in general. So we would love to go deeper into understanding market cycles, how to think about emotional regulation as you go through busts and boom cycles, etc. And you've lived through so many of it. So starting from, having seen market cycles over 30 years, boom, bust, and all of it, what is that one core principle that you have taken away or has stood the test of time for you?
Condensing 30 years into one sentence. Okay. I think it has to be this. It is the principle of not being bothered too much about how much money somebody else has made. Comparisons generally in this field don't help. It's my observation that an investor left to himself or herself is happy with a 15 to 16% rate of return from India's stock market. But that is until he or she sees that the neighbor has made 30%. It's not always the right thing to do. There are normal circumstances where these things don't matter. But situations aren't normal always. And what I think drives this also is the premium that the industry places on being the best or somewhere close to being the best. The best is considered superior. It's easy for an investment advisor or for a wealth manager to push a product that is close to the best because it doesn't take much effort.
And that, as I told earlier, in normal circumstances, it doesn't matter. But there are times when it becomes dangerous, especially in a raging bull market. If we try to be the best, then we can be the best only by being overweight on stocks or sectors that are already dangerously overvalued. And that's not a good thing. So if there's one principle which I want to stress, is not being bothered about how much money somebody else has made, because that is the root cause of the problem.
Hmm. Yeah, well, definitely seeing other people's returns affects you more psychologically than, seeing the growth in your portfolio sometimes. Because I think that goes into tapping into a human insecurity, right? Like you always want to excel and outperform, but you've always had this discipline of being very focused and sometimes even disagreeing with the consensus and believing in contrarian investing. Which is that one belief that you still hold today, which most people would disagree with you?
See, it's like this. It is, I think, very important to be consistently good. There's no doubt about it. But it is not at all important to be the best. And I think it's an extension of the previous point also. The best sometimes can be achieved only by taking crazy risks, especially when the markets become frothy. And markets are frothy more frequently than we are comfortable with. If they become frothy, then we tend to ignore the entry price. When we are bullish about a stock or a sector, and when the entire mass of investors is bullish about a stock or a sector, the entry price is ignored. And when the entry price is ignored, purchases are made at crazy valuations. And we have seen repeatedly that this doesn't work because it leads to suboptimal results later on. So I think this one point is this: it is important to be consistently good. It is not important to be the best. This is one principle that I have learned the hard way.
How did you arrive at it?
There are two events that I think led to this. I think it was between 1996 and 2000. That period was, we were also wet behind our ears at that time. The first was the 1995 to 96 IPO boom. Many of us will remember the Harshad Mehta boom of 1992. After the Harshad Mehta boom, there was an IPO boom in this country. And we, as a set of young portfolio managers, we also bought into a lot of IPOs. It was quite easy to make money for the initial few months. And then after that, what happened was, when the market slumped, we were left holding a set of completely illiquid names. And that was one lesson that I hoped I'll never forget in my life. And I would like to believe that I have not forgotten that lesson. And that lesson number one is, never buy junk, measurable junk in the portfolio, even if it came dirt cheap. It simply is not worth it. The second big lesson happened in 1999. This was the technology boom. You remember that technology boom, the new economy boom, as it was called at that time. Only 3 sectors participated in that boom: the information technology, telecommunications, and entertainment. These were called the new economy sectors, and everything else was derided as old economy. Now, our team, I was working for a company called Zurich Asset Management at that time. It was a subsidiary of Zurich Financial Services. They had an Indian subsidiary. In calendar year 1999, the fund that we ran generated 160% return. But it was still not considered good enough, because there were people who had taken an even more aggressive position in technology stocks or the new economy stocks and had given even 250% return. So that is the time that this sunk in, this thinking sunk in. If 160% is not going to satisfy the investor community, nothing will ever satisfy. Because there is no such thing as enough money. Whatever returns we generate, there will always be somebody who will be willing to take a higher risk in a bull market and give higher returns. So competing on the basis of high returns alone for an investment product is a dangerous concept. That lesson was learned in 1999. So these are the two important learnings that hopefully will always stay with me.
That's really profound. But if you think about contextualizing it in today's time, because last year I think India had maximum number of IPOs any country ever had across globally, right? So maximum number of IPOs happen in India. Do you think, and we had just come out of a raring bull market also, 30-40% IRRs in most people's portfolio, just for the last 2-3 years. And then if you think about it now, for the last year, I think Chris Wood's Greed and Fear letter said that it's been the worst performing market since 1996. How do we contextualize it in today's time in terms of where we are in the market cycle so that the audience can also contextualize it in today's time?
See, usually I don't look at the market as a whole because it makes little sense to me because the market has never been a single monolithic entity. Most people equate the expensiveness of the market to the expensiveness of the index. The index is only one part of it. There are parts of the market that are expensive. There are parts of the market that are not expensive, even when the index is at a peak. I can give you several examples. If you look at 2 or 3 massive bull runs that we have seen in this country, the most important ones are the 99-2000 new economy boom, the 2007 real estate and infrastructure boom, 2016 mid-cap boom, 2018 NBFC boom. Okay, and there are several, and now more recently the post-COVID boom, I call it. In 99-2000, these 3 sectors were raging. But everything else that was called old economy was cheap, even when the index was at a peak. In 2007, real estate, construction, infrastructure, power, these were all very hot sectors. But FMCG was cheap, automobiles were cheap, pharma was cheap at that time. It's good thing that WhatsApp didn't exist in those times. So I'm sure companies like Hindustan Unilever or Procter & Gamble would have been subjected to a lot of memes in those days if had they been there. In 2016, mid caps and small caps just raged. But IT was cheap. Infosys was available at a P multiple of 12.5. Divi's Laboratories was cheap. So my point is, even in today's market, there are several stocks that are cheap. So my point is, instead of looking at the market as a whole, it doesn't make sense to me. It's important to look at companies and stocks individually. I think that's what makes sense. So I think the point I would like to make is there are opportunities in any market environment. But it's important not to look at expensiveness of the index and come to a conclusion. That's the moot point.
Yes, I think that's a great takeaway. And because most people chase right stock at the right time, but you focused on subtraction in the equation, and that has helped you develop an edge in compounding, in my opinion. So, how would you say that subtraction or elimination has helped you? Because everywhere there's news about, okay, you should buy this, and defense is rallying or different sectors are rallying, and everyone's trying to time the market. But what you're saying is very contrarian. So I want people to understand this deeply.
Let us understand the differences between these two approaches. See, I would classify investment styles into 2 broad categories. One is trying to achieve investment success by doing the right things. The other method, which is equally effective by the way, is trying to achieve investment success by avoiding the wrong things. There are crucial differences. The first important difference is that in trying to do the right things, we have to contend with literally hundreds or maybe thousands of variables. Usually the thought process is like this. First, you identify which sector is going to grow the fastest. Within that, you identify which company will grow the fastest. Estimate the profit margins of the company, estimate the earnings growth of the company, estimate the impact of the competitors' moves on this company's profitability, look at interest rate cycles, have a view on interest rate cycles, commodity cycles, currency fluctuations, political trends. That's inevitable in today's conversation. You want to predict how many seats this group, NDA will win or UPA will win and adjust the portfolio accordingly. Look at geopolitical trends, how do we stop the Ukraine war? When will it end? You look at Israel and Iran conflict or Israel and Hamas conflict. Valuations, fund flow, FII flows or domestic institutional flow and so on and so forth. And finally, also you have to have a view on how much of all of these things is already reflected in the price. Now, all these factors are beyond any individual's control. We can't control it. You and I can have a very intellectual sounding conversation about how exactly we should stop the Ukraine war. But the fact is that neither of us has a clue. And it is my belief that nobody has a clue. Okay? So that's one important thing to understand. There are factors in investing which are external, which are not in our control. The second important point to remember is that there is an army of people, hundreds of portfolio managers and thousands of analysts, all of whom who are armed with degrees from fancy universities. Everybody has an MBA and a CFA or a chartered accountancy and CFA, and they have all come from top universities. Everybody has access to Bloomberg terminals. Everybody has access to modern computerized databases. Everybody reads the same annual report. Everybody reads the same analyst meet transcripts. Everybody watches the same TV channels. Everybody reads the same newspapers and magazines. So my point is that it is in today's comparative age, it is impossible for any single person to claim superiority in terms of information availability or analytical abilities. It is not possible. It is not sustainably possible. So there is some other method, which is what I think makes more sense to me. The other method is just identify the factors that cause permanent damage in a portfolio and stay away from them. If you carefully see, there are only 4 factors that cause permanent damage. And all 4 factors are 100% in the control of every investor. So I think it makes logical sense to me that rather than focusing on the hundreds and thousands of variables that we have no control over, let's focus on the 4 factors that we have control over. So that makes more sense to me. And by the way, it is not a bad method to invest. It works equally well. So I think that's my reply to your question.
It's truly about removing complexity from the equation and making it as simple as possible. You make it sound very easy. Let's talk about the 4 factors that you care about.
See, yes, it does sound very simple, but I assure you it is not easy. The 4 factors are these. Don't buy measurably weak or deteriorating businesses. It is easy to identify them. Don't buy any company where the management of the company has shown a tendency to go against the interest of minority shareholders. Don't buy at exorbitant valuations. In other words, don't fall for hype. And 4th is what we earlier discussed. Don't be bothered too much about how much money somebody else has made. Because in my opinion, this is the root cause of all problems. So if you can see this, we can see this ourselves. In a bear market, if you go and ask the average investor, he or she would say, I am satisfied with a fixed deposit plus a few percentage points return. The same person will be unhappy with a 50% return in a bull market. But clearly 50% is not sustainable. So I am saying that if we bother too much about, and the root cause of this is being bothered about how much money your neighbor has made. So if we stay away from these 4 errors, if we have a process to reduce the chances of these 4 errors, I think we are enhancing our chances of success. That is the method that I follow.
Can you share an example where avoiding a mistake helped in a better wealth creation for you rather than a brilliant move?
See, by following this method of avoiding mistakes, the focus is not on making more returns. The focus is on losing less. And this point may sound less glamorous, but it's actually very, very important. Because when you lose less in one cycle, you have more capital to compound for the next cycle. It becomes very important. So it is sounding less glamorous, but I assure you it is as important as making more money. So that's the focus. By following this method, you don't make more money. You lose less in a bear market.
Hmm. So, because, obviously Warren Buffett always says that I only have two rules. One, don't lose money, and never forget rule one. I think that truly matters when you're playing the long-term compounding game. But, we were just talking about how some of the new market entrants have shorter time horizons and they don't always look at it with a long-term lens. Can you share your framework about how to think about long-term wealth creation rather than focusing on, quick bucks or short-term thinking that people get?
There are different kinds of participants in the market. There are people, and I think it's very important for an investor to be clear about what time horizon that he or she is comfortable with, and it is not uniform. I personally speaking, I may be a person with a 3 to 5 year or longer time horizon. There may be another person who has a time horizon of a few weeks. Now, if that person and I get into a conversation about what is a better stock to buy, it will be a never-ending conversation. But both can be right. What I am trying to say is, it is important to ourselves come to a conclusion of what time horizon we are comfortable with and not deviate from it. And if you want to diversify beyond this, you give the money to somebody who follows a different style, because I don't think investing styles are fungible. If I am a long-term investor, I should not attempt to be a trader, and vice versa. So if I want to participate in the trading, or me or any other investor who wants to participate in two different styles, it is better he or she allocates the money to two different professionals who are following two different styles. That is what is important. If I attempt to be a trader, I'll be a disaster. So it's if somebody else has a shorter time horizon, I don't look down upon it. It's just that I am incapable of it. So I will not attempt to do it.
I guess leaning into who you truly are as an investor and knowing your own true nature.
Yes,
and staying
it's very important for everybody to find their own space.
And, you've been a witness to so many market players over the years, 30 years in the markets. What are some of the mistakes that you see even experienced investors repeat repeatedly? Because I'm sure, every cohort has people who repeating the same mistakes. And as someone who sees that from a ringside view lens, how would you define what are the biggest mistakes?
I can think of three readily. One is the attempt to time the entry and exits. At least it doesn't work for majority of people. I concede that maybe a small proportion of people can do it, but that would be a microscopic minority. And let's not fool ourselves. All of us belong to the majority. So that's the truth. See, let's understand this. Timing the market means that we have to correctly predict how these hundreds of variables will all move. Macroeconomic factors, political factors, things like the pandemic, all these things we'll have to contend with, and we also have to contend with how lakhs and millions of investors will react to all of these factors. So it is beyond my comprehension of how anybody can predict consistently, correctly predict how the market will move. So this is one mistake I think even experienced people fall for. The second one is, I think, giving less importance to how much optimism and how much pessimism is already built into the stock price. Because too much emphasis, and I would say that this is the one sadness I have about this industry. Too much emphasis is given to the intellect part of investing, which is important. I'm not saying no. It is an intellect part is usually about the external factors in investing, studying economic trends, studying corporate trends, studying the profitability and comparative position of the company, studying the valuation. All of this is important. But it's also important to assess how much optimism is already built into the stock price, or conversely, in a bear market, how much pessimism is built into the stock price, because this is a very important variable which is ignored in either a roaring bull market or a roaring bear market. So that's the second one. The third one would be, again, it's about trying to be the best. I think I can't emphasize that point often enough. It is important for a portfolio manager or for an individual investor to be consistently good. It is simply not important. In fact, it is dangerous to attempt to be the best. Because the best under certain circumstances can be achieved only by taking crazy risks. And that should not be ignored. So I think these three errors, I would advise against anybody doing these things.
Yeah, those are definitely things to keep in mind. But a lot of family offices, HNIs, promoters, and investors end up watching the show. And I wanted to ask you from the perspective of a family office, maybe planning to deploy, say, between 200 to 500 crores. What is the mistake checklist that they should go through when making these allocation decisions?
Wow. 500 crores. If you're talking to somebody with investable funds of 500 crores, that person will be in the top 0.05% of the population. So it is true that I have managed portfolios for people of that kind. And what I'm saying is on the basis of my observations of how they think. And there are certain needs that these people have. First of all, we have to recognize that people like these with such levels of financial affluence have a wide variety of choices. Not just in India, they have investment options all over the world. So they have, of course, they have a choice of various kinds of mutual funds, private equity funds, angel funds, commodity funds, alternate investment funds, cryptocurrency, whatnot, real estate, precious metals, and all that, and of course, overseas products also. So, whatever investment proposition that we give them or whatever they are contemplating to invest should be measurably different from what they are already getting in other products. So, the overlap between products should be as minimal as possible. That's one. Secondly, a person of this kind, and this is again my observation, does not invest to get rich because he or she is rich already. Their primary concern has been this: I have made my money the hard way. I don't want some smart aleck portfolio manager to come and destroy it. So, of course, they want a decent return, but they don't want their money to be subjected to unnecessary levels of risk. So, they want a logical investment process and a process that promises them a decent rate of return without subjecting their money to unnecessary levels of risk. At the same time, any product that they evaluate should be measurably different from what they are already having. These two things are important. The third thing is there are buckets. Even within the same asset class of equity, there are products which are invested for a 1 to 2 year time horizon. There are products that are invested for a 3 to 5 year time horizon. And there are products that are invested for creating a capital for the next generation, which is 10 years and beyond. So I think it's important not to mix up these buckets and allocate capital efficiently across these three buckets and choose managers who follow these three different styles and stick to them through thick and thin. I think that is what I would, and of course, a portfolio manager is actually one small part of the overall scheme of things. Somebody who has 500 crores, I bet has figured this out for themselves.
Yes, for sure. A lot of them end up having their own research teams as well. Let's get a little lower in this segment. I would say between 10 crores to 100 crores. Do the rules fundamentally change
No,
for this
rules
segment?
don't change. I think it's important to understand there are a few rules here for everybody. Number one, be comfortable about the time horizon that we most like to be in. That's one thing which I think we discussed in one of the previous points. The second is being clear about what we know and what we don't. It's very important. See, of course, we should make an attempt to know. We should make a diligent and reasonably good attempt to know if it's a new technology or so on and so forth. But beyond the reasonably diligent effort, if we still can't understand it, there is no point in pretending to be intelligent. It's okay if we don't invest in it. It's fine. And I've observed this. It is possible to make very decent money with mundane, simple, boring businesses. And it is possible to lose a lot of money in cutting edge technologies. And I've seen several investors do that. So, what is important? I think Warren Buffett calls it the circle of competence. He has also said that it is not important how large that circle is, but it is very important that we know where the boundary lies. So if I understand a particular industry, I should restrict my investments to that industry. If I don't understand it, first I should make an attempt to understand it. If I still don't understand, I have no business in investing in it. It's as simple as that. So I think these are important things for whether the investor is a 100 crore investor or a 10 crore investor. These two things are important. Being comfortable with the time horizon and being comfortable with the kind of industry we choose to invest in.
Here, I would love to ask you, because I'm sure you interact with a lot of family offices. Often, people in my generation, second and third gens like myself, tend to go for private market investments. There is a separate allocation carved out for startups. And I've seen this behavior shift or happen over the last 4-5 years. After the pandemic, it's accelerated even, where a lot of domestic capital has started carving out allocations, say even 10 to 15%. It used to be single digits before, but now it's increasingly become a part of the pie. How do you advise people to think about broad asset allocation and portfolio construction?
See, it's I think important thing is to have a synchrony between the risk-taking ability, the risk-taking willingness, and the asset allocation. That's what is important. So, beyond that, I think it's in private equity. Really, I am not the person to advise any family office because my entire career has been in the public markets. So it's I can speak with confidence about the public markets. Private equity, the asset allocation is entirely up to the individual's choice or the family's choice.
And we were talking about people tracking global trends, what's shifting in the macro picture, geopolitical tensions. A lot of people, are betting on some of the things to happen, like currency fluctuations, commodity prices, etc. But you've stayed far away from all of that. What has helped you in that regard, or having stayed away from the macro, does it help you staying more focused and grounded in one sense?
See, it's not that these are unimportant. It is just that these are beyond any individual's control. I keep repeating this because I think it is important. See, almost the entire focus of the mainstream media and not just mainstream media, even if you look at evening conversations about the stock market anywhere in the country, look at the kind of discussions that will happen. This is my observation, and I'm sure you will observe this too. The discussion will be about which stock will go up. It will be about when it will go up. Which sectors are good for investment. Are large caps better or mid caps better or small caps better? Which will do better over the next several quarters? When will interest rates peak out? What will the RBI do? What will the Fed do, and so on and so forth? Commodity cycles, currency fluctuations, geopolitical risk. All of these things are important, but none of these are in our control. And this is as I told you earlier, my biggest, if I can call it a crib, or my complaint or sadness, is that the external factors or the intellect part of investing get the attention it deserves. But there's something else beyond this, which is something which is in our control. That building a sound temperament for investing does not get the attention it deserves, neither in the mainstream media nor in any ordinary conversations across the country. But it is equally important. So focus on things that are in our control. Ultimately, as an investor, what can we control? We can control what we buy. We can control how much of it we buy. And we can control at what price we buy. Beyond this, there's really nothing that we can control.
Yeah.
So, if we are focusing on the important parts about what is in our control, I think our results are better. And beyond a very intelligent sounding discussion, a discussion about the Ukraine war really doesn't help. That is my experience.
Yeah.
It's not that it's unimportant. It is just that you and I can't do anything about it.
Hmm.
So let's focus on the things that we can do something about.
Yes, absolutely. And you call your style of investing common sense investing. If it's so commonsensical, why is it so rare?
See, I think the reason is this. This is my observation. You can dispute me if you want to. It's because the industry has been primed to do something, doing something right. That's been the majority of discussions. In this environment, if somebody comes and says, "Don't do something," it sounds conservative, right?
Yeah.
It doesn't sound intellectual, okay? And it sounds less newsworthy. So I think that is the reason why these things are given less importance. But I assure you, it is not less important. And by following the style, you don't make less money. You make as well as the other styles. But it's just that it calls for a different time horizon. It does not call for superior intelligence. It calls for a different time horizon. Let's understand this. If we are to analyze this, what is the purpose of the capital market? Let's go to that basic level. The capital market's purpose is to reward efficiency in the use of capital, or conversely, punish inefficiency in the use of capital.
Hmm.
Now, if we are to be in sync with this basic principle, there are two things that we can do. One is choose companies that efficiently use their capital. And we can establish that by looking at the track record or the prospects, etc. Secondly, use our own capital efficiently by not overpaying for what we buy. If you want to buy a good asset and you don't want to overpay for it, let's remember that a good asset is available at a reasonable price only when it is not very popular. When you and I can see the profits booming, the rest of the world can also see. And when the rest of the world is excited about the stock, it is not cheap. And when we buy when it is not cheap, you don't make that much money. I can give you any number of examples. So the idea is you buy a good company when it is unpopular. And a good company is unpopular only when it is going through a period of difficulty. So I am happy to buy a good company when it is going through a period of difficulty after satisfying myself that there is nothing fundamentally wrong with the company's long-term ability to compete in the marketplace. That's very important. If it has a terminal difficulty, obviously we don't want to buy it. But if it's going through a difficulty which we believe and which we can establish through our research that it's a temporary difficulty, it's perfectly fine to buy it at that time. But this calls for a slightly longer time horizon because just because we buy it, it need not turn popular the next day onwards. And there's no such rule which says that a stock should turn popular the moment we complete our purchases. Conversely, it can turn more unpopular after we begin to buy it, in which case we should be prepared to buy more of it. So I never buy in one installment. I always buy over several installments. And usually my average purchase price is lower than my first purchase price. So I buy over several installments. All it calls for is a longer time horizon. It does not call for superior intelligence or superior clairvoyance or anything of the kind. It just calls for a longer time horizon. That's all.
Any examples that come to mind? Obviously, not any recent ones, but any past examples that you can share to make it more real for our audience?
Okay, past example I can share. I want to disclose this. This company is still in our. I bought it in 2012. This company called Indraprastha Gas, and it went through a bull cycle, and then again it the last 3 years it has been a slump. So I again bought it again. I still hold it. So I want to make a disclosure that it is still part of our portfolio and it is disclosed through our newsletters and all that. In 2012, what happened was the regulator at that, the PNGRB, the Petroleum and Natural Gas Regulatory Board, they brought out an order saying that the final selling prices of gas for city gas distribution companies should be under price control. The stock very sharply fell. it's interesting. In 2012 April, I think this order came. Within 3 or 4 days, the company filed a writ petition in the Delhi High Court. The Delhi High Court judgment came within 2 months. It's a very categorical judgment, and I would that order is still available. The Delhi High Court's verdict is still available on the website of the Delhi High Court. It's available for all to see. There were two interesting points which were there in the Delhi High Court. One, that the PNGRB order was ultra vires the PNGRB Act itself. The PNGRB does not have the power to regulate prices. That was one. Secondly, it said that price control is essential only in times when there is a restrictive trade practice, and that is not the case in the present instance. It was categorically mentioned in the judgment. So when the Delhi High Court order came, then the case went to the Supreme Court, and it went on for 2 years there. But those 2 years were a very good time to accumulate the stock, because we took a call that a categorical judgment of the Delhi High Court like this is unlikely to be overturned by the Supreme Court, because there was no ambiguity at all in the judgment. Secondly, there was a news item at that time which said that the counsel for the PNGRB had submitted an affidavit to the court. This was a news item in one of the newspapers, that they were no longer interested in controlling the final selling price of gas. This was enough for us to build a decent position. And when the Supreme Court order also reaffirmed the High Court's order, the stock shot up. But we had to wait for 2 years. So that's an old, case of Indraprastha Gas, where there was an opportunity like this. But recently also we have started buying Indraprastha Gas for quite different reasons.
Very interesting, because I would love to understand, if you remember from that time, what were some of the psychological factors at play for you? Because I'm sure, while the verdict is there was still uncertainty. People must be doubting your decision and a lot of external noise around it, right? So what were the psychological factors for you?
There are two things that are important here. First of all, you take care to see that you don't buy a weak company. See, it is said that investing is a journey through uncharted territory. If it is a journey through uncharted territory, it is better to have strong companions. What are the strong companions I'm talking about? The quality of the business, the quality of the balance sheet, the friendliness of the management towards minority shareholders, and the price at which you're buying. These are strong companions. So if you pay attention to these, you have less blood pressure. Really. So if I stick to businesses that are strong, which are capable of competing very well in the marketplace, where the long-term ability to compete has not been eroded, but some short-term doubts or apprehensions are plaguing the minds of the investment community, that's an opportunity. When there is a mismatch between reality and perception, and when perception is much weaker than reality, that is when you get an entry price. Now, am I right all the time? No. Nobody is right all the time. There will be mistakes made. But as long as the mistakes are 2 or 3 out of 10, I am okay with it. And it happens in any style of investing, not just necessarily in contrarian investing. Any style of investing, if 2 out of 3 will not work out the way we want to. If the price doesn't move immediately, I have no interest in the price moving immediately. I buy with a 3 to 5 year time horizon. So even if they don't move within 1 or 2 months, I'm perfectly okay with it. The important thing also is to communicate this to the person who has written the check. Because it's not enough if I am convinced. I'm having a fiduciary responsibility for somebody else. So that person also should be convinced. So the way to do it is make it clear to that person, whoever the client is, that this is the style we will follow. And there will be times when it will exhilarate you. There will be times when it will frustrate the hell out of you. And prime him to be prepared for this sort of thing. And the second thing is, we are not disappointed for one reason, because we have not bet on a weak company. All companies are market leaders with strong balance sheets, with strong track records of profitability and cash flows. It is sometimes that the market doesn't agree with our hypothesis. That is why we have to change the portfolio, but otherwise it's fine. So this method is not superior to the other methods available, nor is it inferior. It is just different. So what the client gets is, he or she gets a portfolio that will enable them to sleep peacefully at night. And believe me, it's very important for a family office kind of investor. Secondly, he or she gets a portfolio that is measurably different from what they get in a mainstream investment product. So it's important to say this upfront to the client and also periodically reaffirm to the client that we are indeed doing what we said we would do. And it's also important that we don't position ourselves as the one-stop solution for all the equity needs of the client. We are not. We are meeting one part of the client's requirement. Certainly, he or she should go for other kinds of, buckets, as I mentioned earlier. So this is the proposition.
There's a lot of value alignment which is required with your clients, right, when you're pitching these kind of products. Because, when I'm sure, and this must have happened in your real life experiences, where people are like, this other PMS or this other product has delivered X returns compared to yours. Why aren't you able to keep up with them? I'm sure these kind of discussions keep cropping up, because these are discussions that even I'm been privy to. How do you guide people to think about value alignment?
If everybody needs to give the same kind of return all the time, everybody needs to have the same portfolio. If everybody has the same portfolio, everybody will rise together and fall together. That is not in the client's interest. I think it is important that the trajectory of returns is different for each product, because that is when you know that the products are different. If the portfolio is different, the trajectory of returns earned will be different. See, one simple example. People talk about deviation from the index, right? If you want to beat an index, you cannot mimic an index. So if you have a portfolio that is different from that of the index, there will be deviations. Sometimes the index will do better than you. Sometimes you will do better than the index. So it's important it is important to stay the course. That is what is important. So, as I said earlier, the client should choose 3 or 4 or 5 products within the asset class of equity, so that they are different from each other. In 1 year, maybe this will do better. In another year, maybe this will do better. In the third year, this will do better. But all 3 are good. So, if one underperforms in 1 year, it is not necessarily bad.
Yes. Yeah, I agree. Because, a lot of the times people have different expectations from different products. What would you say are realistic expectations to have from the equity class overall?
It's a long term. It has been in sync with the nominal GDP growth of the country, plus or minus 1 or 2%. So, if the nominal growth of this country is expected, if we think that this country is capable of growing at between 6 to 6.5% on a sustainable basis in real terms, we are talking of between 11.5 to 12% in nominal terms. The stock market index will grow at 11.5 to 12%. You can add about 1% for dividend yield. So this is what we can expect if this country is capable of growing at 6.5% in real terms. I don't think that's an unreasonable expectation, but there are times when it will go much higher. There are times when it will be depressed. Like we saw between 2020 and 2024, the Nifty itself grew by 25% compounded. That is clearly well above average. So there should be some mean reversal, which is what we are seeing now.
Yeah.
So I really don't know how long this mean reversal will last. But the other point which I earlier said was, the index is only one part of the whole thing. There are parts of the market that are expensive. There are parts of the market that are cheap. So the index is just one indicator of the overall market. Unless you are an index investor, you should not bother too much about the index movement.
I think it's very important that you've conveyed the realistic expectations to have from this asset class, because a lot of young entrants in the market think that 30-40% kind of IRRs are sustainable. But when you think about realistic expectations, obviously you must also be looking at where are the best places to get your ideas from, and where can you potentially get ideas from. How do you find ideas in today's time, in terms of price discovery and finding the right opportunities?
There is no fixed rule here. Ideas can come from anywhere. It can come from a casual conversation. It can come from a shopping experience. It can come from one of our brokers who are on our panel. It can come from one of our own people, analysts. So it can come from anywhere. But the important thing is that we weigh it against the mandate of the product. That is very important, because and best idea, we don't know if it is the best at the time of purchase. It turns out to be best later on. So it's at the time of construction of the portfolio, we just have to see whether it fits the mandate of the product, whether the fundamentals justify its inclusion, and whether the price justifies its inclusion, and is it superior to the one that we already have. Because usually it's a running portfolio, and if some new idea comes, we have to weigh it against what we already have in the portfolio. So that is what is important. Where the idea comes from is less important. It's very important though to weigh it against the mandate of the product and see if it ticks the boxes. That's where I would place more emphasis.
And when you think about position sizing, you said that, you build up positions as companies are on a decline sometimes even. How do you decide between 50 bips allocation versus 500 bips? Or do you have that level of conviction to go and take a large position right away?
It's like this. I never buy more than, it's an internal discipline that is followed. There's nothing perfect or there's no single best rule for everybody. I don't buy more than 10% in any single stock. I don't buy more than 30% in any single sector. And we have the discipline of keeping the portfolio with a minimum of 4 non-correlated sectors at all points of time. And there is a emphasis given on the liquidity of the stock. So it's the last thing that we would want is our clients to be stuck with a set of illiquid names that they cannot sell in a bear market. So we look at the average traded volumes of the stock in the stock exchange over several months, and the liquidity provided by that stock should be large enough for us to feel comfortable that we can completely sell that position in its entirety within 5 to 6 trading sessions. So that's an important consideration. So the position sizing is a function of 4 or 5 things. Number one is, how competitive is that company in its own business? How strong is it, and how sustainable we think that position is? That's one important consideration. Second is, what are the growth prospects? When I say growth, I am not interested in predicting the earnings growth with millimetric accuracy. That's not my intention. But I should be confident that the ability to grow exists. Whether both in revenues and in net profit terms, we should be confident that the net profits and revenues of the company will be substantially higher over the next 3 to 5 years compared to what it is today. And please note the time horizon, 3 to 5 years. I am not interested in the next 1 or 2 quarters. I am interested in the next 3 to 5 years. And any diligent research will give us a reasonable idea of this. Third is, what sort of people are running the company? And that is one of the reasons why I insist on buying only companies with a long track record. I am not an early stage investor. So I don't buy anything that does not have a track record. A track record gives me confidence. It gives me confidence on 2 counts. A long track record means that the company has been through at least one full cycle. So if it has gone through a cycle, it has gone through a difficult period. And if it has gone through a difficult period, I am confident that the management would have learned something valuable during that difficult period, which they are unlikely to have learned from any MBA school. Because a difficult period is the best teacher in life. So I want companies to be through at least one difficult period, and a 15, 20-year track record gives me that confidence. Finally, I have to look at the price. The price is the last filter. So I don't want to overpay, but I want to restrict my choice to companies of this kind. And so there are some strict parameters we have for valuations, and we don't want to buy simply because it came cheap. We want to buy a good business at a reasonable price. So given a choice between a good business at a reasonable price and a mediocre business at a bargain basement price, I'll any day choose the former.
Hmm.
So I don't mind paying more, slightly more for a high quality business, but I refuse to pay an exorbitant price for any company. So these are some of the filters that we follow.
Like, can you quantify how you think about high quality businesses? Like, in your mind, what is the definition?
The first, and it's important that these are also measurable, because I may claim many things, but for a client or for a wealth advisor, it is important for them to verify that what I'm claiming today and what I'll eventually be doing is one and the same thing. And for them to be able to verify, the parameters should be verifiable. So number one is the track record. I don't buy anything that has a track record of less than 15 years. As I told you, I am not an early stage investor, so I don't attempt to be. I want companies that are well established. Number two, I want a minimum size of operations. And minimum size I have defined as 500 crores of revenue.
Okay.
I'm talking of manufacturing and non-financial side. For financials, we have a different set of parameters. Number three is that we look at the return on capital employed and the ability to generate free cash flow. These are both measurable indicators of how good the business has been. So we want companies with consistently high return on capital and the consistent ability to generate free cash flow. Free cash flow is more important than reported net profits, because net profits can be adjusted with clever accounting. You cannot adjust free cash flow. If you have free cash flow, it tells you two things about the business. Number one, the figures are more believable. Number two, the company is living within its means. So I admire both families who live within their means and companies that live within its means. So essentially, for a family, the ideal thing to do is that the total expenditure, including EMI payment, should be lower than the inflow for the month. Same principle applies to a company. It's okay, perfectly okay, if once in a while the company borrows to fund a capex program. It is perfectly fine. But I am not a fan of companies that constantly require external capital to fund their own growth. Something that we avoid. Similar set of criteria are there for financial services companies. We look at return on assets, we look at return on equity, we look at cost to income ratio, and we insist on a longer track record for a financial services company, and to look at the NPA levels. And these are some of the parameters for the financial services companies. So companies that qualify on these parameters, and we run through the entire set of companies in the database, companies that qualify on the parameters will qualify for the investment universe. The investment universe is a set of acceptable names, and presently it has approximately 210 companies. So out of about 5,300 listed companies in India, 210 qualify. And the portfolio will be built out of these 210. So we pick and choose. We have a portfolio of 25 names, and it will be from this list of 210. Now, we began by saying that we want to avoid the mistakes. And one mistake is buying into a weak business. And no company that qualifies on these parameters can be called a weak business. That's one thing. But it's also important that we place some space for exceptions, because some cyclical businesses will strictly not qualify on these parameters. But if it's a strong company in the cyclical business, I don't want to miss that opportunity. For example, I can give you, about 3 years ago, we bought this company, Larsen and Toubro. By no means it is a weak company, but it does not qualify on these parameters of high return on capital or free cash flow, because it happens to be in a cyclical business. But if a strong company in a cyclical business is available at a very good price, we should make some space for exceptions. So we have a small space for exceptions also to fit in this parameter. One other example I can give you, during the COVID time, we bought State Bank of India. The State Bank of India is not a weak competitor, but it was available at that time at a very attractive valuation, even though it did not qualify on the parameters that we have set for ourselves. So to accommodate exceptions like these, exceptions are also strong competitors. It's just that we need to make some space for them. Because why? Because it is important that while it is important to be disciplined in investing, it's also important that we don't get too dogmatic. There should be some element of flexibility in equity investing. but with a strict limit of what the total exceptions will be. And each exception is done with our eyes open. And these are some of the names which I spoke. But everything that we have spoken so far, we have only spoken about the past track record of the company. While it is important, it is not sufficient. We have to satisfy ourselves about the prospects this company has. And for that, any diligent research will give that information. As I told you, I am interested in finding out whether the company's competitive position is intact and is expected to remain intact in the foreseeable future. That's the thrust of my research. Secondly, I am interested in knowing whether the company retains its ability to grow. It need not grow in the next 1 or 2 quarters, but it should retain the ability to grow and ability to maintain its market share. The third point is about the management. And the only way we can judge management is to look at the track record. There is really no other way. The track record gives us important clues about capital allocation. Whether they have destroyed return on capital, whether they have unnecessarily diversified, have they been consistent about their dividend policy, have they been transparent in meeting the investment community during good times as well as during bad times, because several companies are more than happy to meet during a good time, but they are remarkably close-mouthed when it comes to a difficult time. So I would much rather appreciate a company that is willing to discuss the problems with the investment community, what problems they are facing and what they intend to do about it. So even if they don't succeed in all of their plans, it is the transparency that is attractive. And finally, are they routing profitable businesses through unlisted entities and not through the listed entities? These are some of the red flags that we would seek to avoid. Finally, it comes to the price. As I told you, I am not interested in buying something simply because it came cheap. I don't want to be, this value investing has got a very very wrong connotation. People believe that value investing means you should not buy anything above 9p or something like that. That is not value investing. Buying junk for a cheap price is not value investing. You have to buy something of quality and not overpay for it. That's what is value investing. So I am not interested in buying a junk stock because it came cheap. And a good company is available at a decent price only when it is going through a period of difficulty. There should be some doubt, some apprehension, some fear about the company's immediate future. We are happy buying in such conditions. So these are the checklists that we follow.
Here, I would love to ask you because, there have been news cycles about different companies. Like, I can take an example like Adani Group just went through this news cycle of, going through a turbulent time but coming out in the clear. A lot of people would have said that, that was a good time to invest because now they've emerged out of it. But how do you differentiate whether what a company is going through is temporary and something that they can come out of versus permanent damage?
See, there are 2 or 3 things that we stay away from. Highly capital intensive businesses we generally avoid. Highly cutting edge technologies we tend to avoid because these things change very fast. And it is not necessary to make money only from these things. I have seen really very boring businesses generate a very good return provided they are bought at a good price. I'll give you one example. 4 years ago, was anybody recommending public sector shares? No.
Only Rakesh Jhunjhunwala.
Nobody was recommending public sector shares. But today, public sector is the darling of everybody when the price has already gone up 10 times. So the point is, every sector, every company goes through a trough. So if only we have that time horizon that is long enough, if we get over this anxiety of making money the moment we buy that share, if we give up this one thing, there are opportunities available. So the focus is always on why the stock should move. The focus is never on when it should move.
Yeah.
And sometimes we are lucky. The market agrees to our point of view within a few months' time. Sometimes we have to wait for more than a year or maybe 2 years. Sometimes we are proven wrong. But that is true of any investment style. It is not just only with contrarian investing. Any style has this, Very sure.
Here, I think this would be an interesting time to discuss when you decide when to sell. Because, sometimes the market might not agree with you for a very long time, a year, 2 years, valuation, thesis, etc. There are things that you will start questioning, right? So, when do you decide when to sell?
It's an important question. There are only 4 reasons why I sell a share. The first reason is the assumptions with which the share was bought in the first place become invalid. Something will change. But thankfully, this has been a very infrequently used reason in my career. Very, very rarely I use this. But I will sell if I find out that the assumptions have gone all right. I will sell irrespective of whether I'm making a profit or a loss at that time. That's no doubt about it. The most common reason to sell a share is it has gone well beyond what I think it is worth. This is the most common reason to sell a share. The third reason is an opportunity that did not exist earlier suddenly becomes available. And it is superior, in our judgment, it is superior to the one that is already in the portfolio. Then I will switch from A to B. I may buy company A because company B, which is a comparable company, was very expensive at that time. After several months, company B becomes much cheaper, or some other company comes on the horizon which was not available at before. It comes on the horizon and it is cheap, is better than the one that we already have. Then I'll switch from A to B. The last reason is when the client wants a redemption, either a full or a partial redemption, in which case I have to sell. So these are the 4 reasons we use to sell a share. Your other question was, how long will you wait? I have a waiting period of 3 years. And 2 conditions are important. The stock should not have given any returns for 3 years and the fundamentals should not have improved. If the fundamentals have significantly improved and still the stock doesn't move for 3 years, I'll still hold on to it.
Would you buy more?
I'll buy more if the fundamentals improve. But if both these conditions are satisfied, even if they don't deteriorate, even if they don't improve, and the stock has remained stagnant for 3 years, I'll replace it with something else. Well, I think it's important to have a balance between idealism and pragmatism.
Yeah, because, since you mentioned the PSU stocks, I also invested in some of the names that you mentioned, SBI, Canada Bank, etc. Because the thesis there always was that, ICICI Bank had a comparable portfolio to what SBI or Canada Bank had, but, the valuation-wise, there was a huge differential. So when you're looking at opportunities like this, where, it's visible in the numbers, but like it just takes so much time, like it took almost 3-4 years for it to
More than 2 years.
yes. So at that point one starts questioning their conviction, their belief, or you're also questioning of yourself about the opportunity cost.
Speaking of, let's discuss the first point first. The fundamentals were constantly improving in State Bank. It was there for all to see. State Bank of India's market share between 2010 and 2020 on almost all parameters, on housing loans, on car loans, on personal loans, on corporate loans, it was rising. The market share was rising. State Bank of India, the NPA levels were falling. In 2018, the NPA level was 5.3%. In 2020, the NPA levels were 2 point something percent. I don't remember exactly now. Somewhere in the mid
2.6 or something.
Somewhere 2.3, 2.4, somewhere around that time. So NPA levels were falling, market share was rising, and they had greater market share in the new age banking, internet banking and mobile banking. Their market share was more than HDFC Bank and ICICI Bank. They had a biggest branch network, 20,000 branches, 50,000 ATMs. And 1 out of 4 Indians were customers of the bank. 1 out of 4 Indians. And we are talking of 130 crore people. All the state governments, all the central government departments, police forces of all states, Army, Navy, Air Force, paramilitary forces, all the accounts were with State Bank of India. They had a large and successful mutual fund subsidiary. They had a large and successful insurance subsidiary. And the stock was available for 0.7 times book value, which was at a multi-year low. I had no clue when it will reverse. But the pricing was so attractive that, and we were not betting on a weak back. The argument, if you remember, about 4 years ago was that public sector as a whole was losing to private sector in terms of banking business.
Yeah.
That was the argument.
Yeah.
But it was not true for State Bank of India. So that's you can't paint everything with the same brush, and that gives an opportunity. So the perception was weaker than reality. So that gave an opportunity.
Are there any non-negotiables that you have as a list in your mind when it comes to sizing and liquidity?
I don't buy anything less than 3%, or lowest I go is 2.5%. Because having a 0.25% position in a portfolio makes no sense to me. So even if that stock quadruples in price, it doesn't move the needle in terms of the overall returns of the portfolio. So you have to build a decent position. And as a measure of risk control, I don't go more than 10% in any single stock.
Hmm.
One more thing is, I don't believe that a portfolio should consist only of the best ideas. And best ideas are usually defined as the one where the portfolio manager thinks that the maximum money will be made. I deliberately balance the portfolio with a mix of fast growing businesses and blue chip stalwarts, secular growth companies and cyclicals. So it should deliberately be a mix.
Hmm.
Because the portfolio construction is all about balance. It is not, you shouldn't skew the portfolio too much to one side. So that's my way of looking at it.
Hmm. Over the last few months, or rather year, a lot of investors, came out and spoke about how they were holding large portions of cash in their portfolio. They had major cash reserves and they were waiting for corrections, etc., to step in. In your mind, when is holding cash actually a discipline, or is it like, how do you think about cash reserves in your portfolio?
Cash is always a residual asset. I don't pre-decide that I want to hold this much cash.
Hmm.
It's a function of the extent of opportunities that are available. And as we have already discussed, the opportunities are not a function of the level of the index. We have seen this repeatedly. Even if it's a repeat, I want to say this once again. In 99, 2000, the index was at a peak. But FMCG and old economy stocks were all cheap. In 2007, the index was again at a peak. At that time, pharma, automobiles, FMCG stocks, some companies like Page Industries and Eicher Motors, they were all cheap. In 2016, mid caps and small caps were roaring. IT was cheap, pharma was cheap. 2020, 2021, there were so many high quality stocks, which were high ROC stocks, which were roaring. But ITC was cheap. State Bank of India was cheap. Even today, there are several that are not expensive. I am saying that, excuse me, given this condition, having a fixed idea of what cash we will hold doesn't make sense to me. Possibly, there are times when I have been 99.5% invested. During the COVID time, I was fully invested. I never go to 99.5%, but that was an exceptional period. Usually, I have about 6 to 7% in cash. I think that is more than sufficient. The other question you had was about
Non-negotiable.
non-negotiable. I think governance is non-negotiable. Corporate governance is non-negotiable.
Hmm.
And one more thing is, highly capital guzzling companies, I really stay away from. Companies with very fickle demand trends, where the demand fluctuates violently, I will stay away from. And as I said, very new age businesses, very cutting edge technologies, where the technologies change rapidly, I tend to stay away from.
You mentioned a couple of sectors which were cheap in different years. What would you say is true for today in 2025?
It's,
What's looking cheap to you?
most of them are in our portfolio right now.
So you don't want to, just broader sectoral themes, not asking for specific names.
So I have a decent exposure to consumer discretionary spending stocks. I have some 2 or 3 private sector banks, which I still think are reasonably priced. I have some insurance stocks, which are I think quite reasonably priced. Um, Utilities, I have 1 or 2 which are reasonably priced. So these are some of the names which are there with the portfolio.
And because this show is called The India Opportunity, and I know you are a believer in the India story, what excites you about the next decade in terms of investment opportunities?
So I still think that consumer spending is not just a lull that we are going through. I think for the next couple of decades, consumer spending and both FMCG and consumer discretionary spending will continue to see a strong demand in this country.
I think the GST reforms are a
That is
reflection.
one. That is one important catalyst. Um, I think the multiplier effect of the various infrastructure projects that have happened over the last 4 or 5 years will definitely help. I also think that the PLI scheme targeting selected industries has been a success. We have seen remarkable success in mobile phone manufacturing. I'm sure there are other things that are also coming up. So these are some of the things that make me feel bullish about the country.
Hmm. Are there any risks that you foresee that could potentially derail the India growth story?
I'm a bit worried about the slower pace of job creation. That's something that can derail, uh, especially in a country like India where there are a very large number of youngsters. I think more than 50% of India is less than 30 years old. So it's vitally important that they are gainfully employed, and that is one thing that I think is still not happened to the extent that we think it should happen.
And with AI coming into the picture, I think job loss is a real insecurity that a lot
Some
of people are
industry,
feeling.
yes. I'm not an expert on that field, but I keep reading about what sort of potential job losses can happen in which sectors. We try to stay away from the vulnerable sectors to the extent possible. But there are some sectors where AI will not have such a big impact, and we have decent exposures come some of those companies.
Is that something you actively think about, like making your portfolio
No,
disruption
we,
proof
we,
in
we
one
have
sense?
to we have to because it's in if there are mundane things like mundane jobs like low level coding, etc., which I think is a more vulnerable part, we try to stay away from such industries. So because it's an important technological change. There may be a good deal of hype in it. I also happen to think that there's a good deal of hype in it, but it is disruptive. I can foresee that it will be disruptive, so we have to be careful.
Hmm.
I can't predict exactly what will happen, but I can prepare. So I think to the extent possible, we have ring fenced the portfolio to avoid such industries.
And lastly, your thoughts around, all this geopolitical tension which is happening around the world. There's a change in world order there, and there's a change in supply chains that have existed till now. There's a new relationship that India will explore in terms of establishing new supply chains. So will be sectors that benefit from this kind of growth, and also FII flows that happen in this industry. So, are there any themes that you broadly think will benefit in terms of a structural shift that might global
Uh,
investors might not appreciate?
Generally, I don't as I told you, I don't place too much emphasis on geopolitical analysis because it is really beyond my paycheck. I would rather focus on companies that have the ability to withstand any storm, even if that storm does come. That's the focus.
Hmm.
So it is I try to explain in metaphors. A portfolio manager, I think, is similar. The job of a portfolio manager is similar to the job of an architect. If the client wants you to build a house next to the seashore and doesn't want to be affected by the tsunami, the architect's job is not to predict when the next tsunami will come. The architect's job is to build a house that is strong enough to withstand a tsunami, even if it does come. Similarly, my job is not to predict how the geopolitical scenario will move. My job is to build a portfolio that can withstand a shock, even if it does come. So I'm confident that we are doing that. So that's the idea. So can I predict all these things? No, I can't. I don't even attempt to.
Every answer that you've given me has such a strong connotation of an internal discipline that can only come from years of, training yourself at it, because it's so easy to get carried away by external narratives, the noise in the market. But, I know that internal dashboard and being true to your internal nature is very important to you. I would love for you to share your framework in terms of how you built this internal discipline over a period of time so that our audience can also benefit from it.
As I told you, there are 4 or 5 points which are important. The first one is being comfortable about what time horizon that we are really comfortable. And each person has to search this for themselves. There are people who are comfortable with a 1 week time horizon. There are people who are comfortable with a 10-year time horizon. There is no perfect answer to this. What is comfortable for that person, he or she has to search for himself or herself. And then stick to it. Excuse me. The second thing is being clear about what we know and what we don't. And sticking to companies that we understand, the businesses that we understand. It's perfectly okay if we miss an opportunity. It's much better than losing money permanently. Losing an opportunity doesn't matter at all. If one goes, another one will come. But if money goes permanently, it will not come back. So it's important to remember this. And there are 5,300 or 5,400 listed companies in India. I'm talking only of listed space. We need 25 to build a portfolio. So we'll find out 25. No problem. Third is being careful about what we buy. How much of it we buy and at what price we buy. All these are important. Well, you can't pay an exorbitant price for even the best business in the world. So, and finally, the first point that I raised, don't be bothered about how much money somebody else has made. Up to a point, competition is good. But beyond a point, competition gets destructive. So it is important to stick to what our investment goals are and then don't deviate just because somebody else has made more money or claims to have made more money. I'll give you one example. My late father, in the last 10 years of his life, he invested only in bank fixed deposits. He didn't trust the investment abilities of his son. He was happy with it. 7%, 8% return from bank fixed deposits. At that time, if I had gone and told him, no, on a risk-adjusted basis, you should do this and do that and get higher returns, it would not have worked. For him, he knew what he wanted. He knew what he did not want. And he was happy with the returns. That's what matters, right? So it's what matters to us. We have to decide and stick to it. Let's not be guided by what somebody else is doing. I think if you were to ask me for an internal conditions checklist, this would be it.
Because you often say that salvation lies within. What are some of the beliefs that have served you well to be able to stick to this kind of discipline? Because it's not easy, It takes a certain level of courage, but like soft courage. It's not visible to the world, but it takes a lot of hard work to stay true to your inner work that has to be done over a period of time.
I think I partially answered this in one of the previous questions. There are 2 cathartic experiences I went through. One was between 95 and 97, that IPO boom, where we also made a lot of this. We had an anxiety to prove to the world that we are more intelligent than everybody else. And we bought a lot of junk in the portfolio, and that we took more than 2 years to clean the junk from the portfolio because we were stuck with a lot of illiquid names. The resolve came at that time that after that, junk will never be part of the portfolio. It is simply not worth it. Even if it came free, I don't want it. The second was about the 99-2000 new economy boom, where if we gave 160% return in 1999, I don't mind sharing it. At that time, that fund was called Zurich Equity Fund. Today, that fund is called HDFC Flexi Cap Fund.
Okay.
It has got, I think, about 82,000 crores of assets under management. It's one of the most popular funds of the country. In those days, it was called the Zurich Equity Fund. You were managing it as a team. 160% in 1 year did not satisfy the investment community. That is when it sunk in. Because there is no such thing as enough money. There is none. So it's much better to be consistently good rather than attempt to be the best. Because the best is a transient position. It's futile trying to be the best because the best is not a sustainable position at all. But being consistently good is a sustainable position. If I think if I can give this one takeaway from this podcast, it will be this. Being consistently good is far more important than trying to be the best.
Success breeds a lot of ego and losses can crush confidence. Wait, what you're talking about is, having equanimity of the mind and not letting yourself get affected by both sides, right? Because 160% returns can't satisfy investors, and maybe losing money will obviously bring out the worst reactions. So how do you come back to this equanimous position in your mind?
Constantly remind ourselves of the mandate that the products are supposed to deliver. See, it has I think the portfolio manager's primary job is to be faithful to the mandate of the product. It is not to show off his or her intelligence to the world. That is not what they are there for. The portfolio manager is supposed to take care of somebody else's money and in accordance with the mandate of the product. So, periodically reminding ourselves of the mandate of the product is vitally important. Second vital importance is in communicating this right from the signing time to periodic intervals to the client. That we are indeed doing what we said we would do. So, it's important that there is a match between a congruence between the ability of the portfolio manager and the interests of the client. And this has to be reinforced with constant communication. And I have observed this. Some clients are insistent on frequent meetings in the first 1 or 2 years. After that, they see that we are just doing the same thing that we said we would do and they let us be after that. So it's been our experience like that. So you could say that we are boring. But consistency is boring. And one of the important features of portfolio management is to be consistent. I don't mind being boring.
You've said it a few times now that, no money is enough. What does enough money mean to you now after so much time in the markets?
Money is important for everybody. Money is important for everybody. But there are things that are also important beyond money. So I think a combination. I think a successful life is a combination of a good health, combination of a good family, a good circle of friends, and money to meet your everyday needs. I think beyond this, and what you can, your surpluses you give away to people who are less fortunate than you. This is what matters to everybody. So I think a combination of all of these things is, in my opinion, what makes a successful life.
If there's one rule that you would want your children to inherit about wealth creation or investing, what would that be?
I think they should realize that spending less is equally important to making more.
Yeah, because this generation needs a reminder of that. Right?
I think it's important.
Yeah, because constantly I think the spends on experiences, travel, all those things have gone up.
There's nothing wrong with that, but it's just that it has to be in proportion to the money that you already have. It should not be disproportionate to that. That's very important.
And my last question, as investors, it's very important to have strong opinions, but loosely held, as we call them. Have there been any beliefs that you believed for a long time, but have abandoned later in life? Something that you've changed your mind about?
Yeah, I was not born with this investment philosophy. we change because of the experiences that we had, the knocks that we suffered, and also because of the good fortune of meeting some very good quality investors along the way. I think the experiences of 95 to 97, of 99, 2000, and then of 2007, and then the Lehman crisis, all of this has molded our investment thinking. I think it's important that in an investor's journey, he or she should go through at least 3 or 4 bull and bear markets. That's when the thinking will really, get refined. So that is one thing. And I've been fortunate to meet some very great investors. I would be gratefully recollect my meetings with the late Chandrakant Bhai Sampath. So I think he's a person who has influenced a great deal of my thinking. Not just as an investor, as a human being, you could look up to him. So he's that kind of a person. That's one. And of course, I have several people. There are too many to recount. I have been fortunate enough to work with people like Sanjoy Bhattacharya. I have worked with Prashant Jain and Chandresh Nigam as a team. I've learned a lot from people like Vinod Sethi, like Nimish Shah, Durgesh Shah. There's so many of them. I'll be missing out on several of them, so I don't want to complete the whole list. So and there are some good books we read along the way. We have been fortunate to read some good books at the right time. These have molded our thinking. So it is not as if that, right from the time I graduated, I've been an investor of this kind. Nothing of the kind. Mistakes along the way, we change. So that's how it is.
Yes, thank you so much for taking out the time to be with me here today. I think this was a fantastic episode with very rich insights and very profound insights also, because it's so easy to get carried away in the external noise. But your conversation is a reminder to keep coming back to your true core and identifying what works for you and identifying what your true nature is. Which is why, when we discussed having this conversation, the emphasis that you wanted to put on the internal work was so important to me as well. Because I think these are timeless principles and evergreen content which, the audience will always appreciate.
Thank you.
So it was truly a pleasure hosting you today.
Thank you. And I'm grateful for inviting me on your podcast.
Thank you. It's not every day that you get to sit across from your icon and ask them all the questions that you wanted answers to. And that was the day for me today. If you enjoyed watching this episode, please remember to subscribe to our channel so that you get notifications every time we drop another one.